kinds of stuff to even get to the screen. To even get here, I gotta fill out like a couple minutes worth of stuff. Okay. Can you guys see my screen? Yeah, you can see my screen. Sharing it here. Okay. So if we look at our x-axis of time, right? You have your y-axis and your x-axis, right? And then you have your time, and you also have your price, right? You have your y-axis of time and your x-axis of price. When is, right, when we're flowing through time and price, and this has no way, and this in no way dictates any type of price action. When is it the perfect time to mark out your standard deviations? You would think, right, that, or I would like to think that when we're coming down, right, on a downtrend, you could technically, wrong one, you could technically map out your standard deviations according, right? And every time you hit the 2 or 2.5, or you hit the 4, right? You hit the 4, that you have an SMR, right? SMR at the 4 does what? Brings us up to what? The 2 or the 2.5 of the other standard deviation, and so on and so on. But which one of these, right, would you consider the peak or the perfect, right, time? Any one of these, perfect world, would have hit our price projections, right? But we want to always catch a big giant move. We always want to catch the 4. So when is the 4 accurate and when is the 2 accurate? Only time will tell. And then you add price to it, right? So time is where we're going to figure out which spot is perfect to hit. And price is where we're going to identify our, excuse my writing, our PXH and our PXL. We all already know everything that I'm explaining right now, right? You have your protraction of time and price, but when are the correct times to hit that standard deviation? If we look at the chart today that I had out, and in no way am I saying that my standard deviations are better than yours. I'm just explaining that this is what I seen. But if we look how I explained earlier, right, we had a New York equities open, right, 8:30. My 8:30 is 9:30 New York. We had a equities open where we did what? We had a really nice standard deviation, right? We had a nice drop, sorry. We mapped out our standard deviation. And what I see a lot in the chat is mine is different than yours is different than mine, right? If we look at where I mapped out my, we'll get rid of these. If we look at where I mapped out my 1 to where I mapped out my 0 line, right? And if we extend price out, we can see that according to ICT, right, once we close below our change in state, what happens? We do not close above and we drop. Where do we drop to? We drop to the -2, 2.5, which is what? One of our SMRs, right? One of our smart money reversals. If we look at all the other standard deviations that I had out, we can see here, right? Mapped it out to this candle. Change in state, never hit. 0.5 never hit. We did come back to the accumulation range and come up. but we manipulated under what? Manipulated under this flat line, or this order block got tapped into, right? So which one of these trades would you have rather taken? Obviously, you would have wanted to take this one, right? Why? Because of how many handles it dropped. We'll say we got out at the 2. I always say get out the 2. How many handles, right, we got into. So if we would have taken this trade, this one would have given us 130 handles. If we would have taken this trade going up, right, it would have gave us 116. If we would have taken this trade going up, again, perfect world, we get in right where the zero line gets crossed above, because like we said, once we pass that 0, we don't come back to it, right? Like this example, 91. So which one of these 3 trades would you have rather been one and done? Equities open, right? This is a good trade, this is a good trade, but we want the more bang for our buck. When I say time and price, when I say, sorry, standard deviation, when is the right time to place it, we don't want to tie ourselves down to the chart and stare at our chart for what seems like 24 hours, right? It's 23 hours in a trading day. We don't want to stare at our chart for 23 hours. So rather than stare at our chart for 23 hours, let's find out where we can project price to hit a certain level, right? When we can project, again, price to hit up to what? A certain level. And we look at our protraction, right? Our x-axis of time and price. So one of them I gave away. I'm sure you guys already know. Equities open. Why is equities open a good place? Oops. Why is equities open a good place to look for the opportunity to what? To sweep price, right? PXH. Here's your PXH right here, right? And if we're coming down this way, here's our PXL, or our range, right? Our dealing range. Previous high, previous low of the day, which I explained to you guys in the how to identify dole, right? Remember the video that I made with you guys? We're just looking at previous day high and low. Easiest way to find your dole, previous day high and low. Now, if we look at price and when time hit price, what did we do when the right time hit our price, right? Again, if we look at our x-axis of time and price, one of our perfect times to add our standard deviation is equities open, right? Equities open, because we can expect what? We can expect the injection of liquidity. The injection of liquidity are the perfect times to map out your standard deviation. We're going to do our second version right now. Our second version, if you're following me, let me see if there's any questions. I don't think so. Our second opportunity to look for the perfect time to add your standard deviation would be what? I already gave it away. The injection of liquidity at equities open. So where would our most likely next spot occur if we're going backwards in time? If we're going backwards in time, I want to look for an injection of liquidity where? When London opens and Asia finishes. When we're done with Asia, right, is here, and when we open up London. So now we have 2 spots where we can what? Expect, and I said this earlier to Itchy, where we can expect the Judas, or we can expect the Judas downside to the upside or upside down, right? We can expect that Judas. Why? Because of that injection of liquidity. So right now I gave you guys two of them. One of them, equities open. The other one, London open, right? When can we expect our next injection of liquidity or our next opportunity to find what would look like or what would constitute as a Judas, right? Remember, Judas is the fake move before the real move. If you watch any Judas swing video, they all say the same thing. The Judas is the fake move. So where can we see, just based off of our Asia, New York, London, and New York highs and lows, where can we see our next fake move? Here. Where what? Where London closes and New York stays open by itself. This one is not an injection of liquidity, but this one is where you can get another false move. Your false move is going to happen when what? When we take all our orders out of the market for the session. So if we look at our price, right? What are we looking for? Previous low, previous high, previous low, previous high. And if we go even further back, previous high, all right, let me go lower, previous low. So what did we do during the first injection of liquidity? We broke above Asia high, and then when London started, which was what? That first injection of liquidity, then we look for that manipulation, that fake Judas. You can barely see it, but you can see how we go up and we sweep, and then what do? We attack Asia low, right? Now we look at our next one, right? Our London high, our London by itself high was this. This was London by itself. Similar to what I just showed you with Asia and what I've explained to you guys, like we like to sweep ourselves, right? We like to sweep the engineered liquidity that's created on the day. If we look at where Asia's high was before the injection of liquidity, what happened? False move up, correct move down, right? Now we have our London high. This is just London by itself. Now look what happens when New York enters the game. Literally on the candle, New York entered the game. What do? We created the false move up, and then what? The correct move down. We created that Judas, and then we created the Judas. Now, if we look at the third one where there's not an injection of liquidity, what happened here? False move down, manipulation, right? And then what do? We went all the way up, and what did we target? We targeted our PXH, which is our own high of day. Or we targeted London, right? Because New York was the high up here, and then London was like a tick lower. So we swept that London high. So when we're looking at time and we're looking at price, the three areas that we want to look for, right? Because this is where the market opens, and then it opens a little bit, and then it's Asia, then London and New York. We want to look where? Injection of liquidity, and then we want to look at where the last session hangs out by itself. For me, these are the three perfect areas to look for your standard deviation. Now, when you pair your standard deviation up on these three moves, this is just an example for today. We'll go back in time right now. But just for today, you can see how it played out perfectly, right? Injection, swept our high, injection of liquidity, false move to where? What did we attack? Remember, this was Asia's low until London opened. This was Asia's high until London opened. So if we go back in time, that is actually Asia high and Asia low. And as time passed, what do? We waited for that London open. Then what do? We manipulated above our Asia high. We swept ourselves. And then what do? We dropped down. And then we did what? We swept ourselves again. So this specific injection of liquidity provided two opportunities for a trade, the short or the long. Because what did we do after this, right? Then we went back up, right back to that high. Two opportunities, because all we did was identify our time, right? What's our time? the injection of liquidity, and where the session falls short by itself, where the session turns into itself. So super simple, right? Three areas that are not PD array related. You don't have to wait 23 hours for your trade. You don't have to sit there, and anticipate what price is going to do and think it's going to go this way or it's going to go here or it's going to hit this key level then drop. It's going to go internal liquidity to external. All you really have to do is wait for that time. Then all the concepts bleed into each other. You can have it all mapped out before. That's totally fine, right? You can map everything out. You can have your PD array mapped out, right? You can have everything done, your Asia high, this is your Asia high, this is your Asia low, right? You can have it all mapped out and you can take your trade. But it really only takes, when you pop into the chart, a couple minutes to see what's going on. A couple minutes to see where we're at on the chart, right? Where we're at on higher time frame order flow, where we're at when it comes to 20-day IPTA, 40, 60-day, right? It doesn't take that long for us to identify those levels or those dealing ranges. And it doesn't take that long for the trade to be completed, right? But if we identify the time, right, and price access, and we look for, like I said, the injection of liquidity, or when London ends, we can find our standard deviation projection can work to our favor. Any questions? Yeah, what's up? What I can right here. So no, it makes perfect sense. So I was hoping one of you guys would ask about it. This is one of your power of three starting, the start of your power of three. If we look back at the video that Min showed us, right, that Fortune showed us, he explains that the power of three starts in one of three areas. One of the three areas is our London kill zone. The next one is our London by itself outside of the kill zone. And the last one is your delayed one, right? You have your generic, your regular, and your delayed. And what's your delayed one? Your delayed one is the Judas at equities open. So this middle that you're talking about is what I consider a fourth time. So you have your 1, your 2, your 3, and your 4 times of the day that you can expect what, not to add your standard deviation, but where you can expect the manipulation. And when you can identify and start identifying the manipulation within these areas, identifying the manipulation in different areas becomes easier, and you're able to do what, you're able to identify how standard deviation can work outside of those time frames, and you can catch moves that are not inside of your time and price x-axis, right? This one is when we closed, but I was still able to identify and catch it. And we technically didn't manipulate anything. If you look, when we hit that low a day, I mean, some would say, oh, you manipulated it underneath this. Well, I get it that manipulation can be X amount of handles, but this is 100 handles right here. Like some would say that's not manipulation. That's just a straight downfall. If we look here, right, there's really not much to manipulate under. You would have to say this is where you manipulate under. But if we look at price, we technically didn't, again, manipulate under anything. We just dropped, right? And I'm sure someone can find something on a higher time frame, daily fair value gap or something. But what I'm looking at here is we technically only dropped underneath the 2.5, which is where our SMR range is. So when I identified the SMR here, right, then I added my standard deviation, which one of the guys had in the chat. He had the same exact one. And this thing hit to -4. And then what do? Then we drop down, right? And then again here, we technically didn't manipulate underneath anything either. And if we remove all of our drawings, this low right here technically didn't manipulate under anything. You would want it to what? Manipulate underneath here, right? You would want to manipulate underneath this. Now, if we go back to time and price, right? If we look, this is what I was showing Itchy. If you look at time and price, right, I still have my standard deviation mapped out from here. Because if we look at this bigger fib that was drawn out, right, this bigger fib that's drawn out, look at where price sits on, I think I had it on the 15 minutes. Sorry, I just want to make sure that I put the fib right for you guys. It would be the same exact candle here. If we look at where we traded all of yesterday and today, right? Oops. You can see that within our accumulation range of 1.1 to 1.5, what were we doing? Accumulating. And then if we map out our zero line, right, our standard deviation zero line from back there, what is this? This is our change in the state of delivery, right? And if we map out the point 0, right, and this is the low risk buy sell, what did we offer on that very, very, very last drop before the run up? We offered the very last low risk buy sell before we do up. And this is what I'm looking at for tomorrow, even with news, news could drop us, news could make us go higher. But based off of this standard deviation that I'm looking at, which is the higher time frame one, we accumulated perfectly, dropped down, offered the last change in state, and then we offered the last low risk buy sell to do what? To come back up and attack this 4. And if we map out the 4 on our horizontal line, where does it take us? All-time high. Is it going to go there? I don't know. But according to my standard deviations, if I am trading according to my price projections, that's where I want to see price hit, up here. Because why? We're still following the standard deviation that was made from this news candle, right? We're still following the different levels and what the definition of them are. Zero is change of state. Low risk buy sell, accumulation, SMR, right? Little free zone, and then another SMR. If we go back to the standard deviation that I had here, what happened at the 2 and the 2.5? It was where we hit and we have the SMR, the smart money reversal. So the whole day we were accumulating, we were trying to get above this smart money reversal. And then when we got into the 50% of this standard deviation that I drew on Friday, right? If you go back to the 50% of this, what did we do? We tapped into the mean threshold, right? The consequent encroachment, 50%. And then we dropped all the way down. It was a big drop, right? What is this? Like 246 handles. But where did we drop to? We dropped down to change in state, where we came up. And we came right back up to here. So in hindsight now that we're looking at it, right? But if we look at it on a higher time frame, oops. If we look at it on a higher time frame, right? And this is our standard deviation price projections. I mean, it's pretty obvious, right? On the higher time frame, like all we're doing is respecting this change, this not change in state, sorry, this standard deviation. We could very well, news could very well drop us way down here, right? I mean, we manipulated above this. News could very well drop us. News could, I think there's news tomorrow and Thursday, right? News could drop us, and then news could drop us again. We can go up, and then news could drop us, right? We can go up, and then news can cause us to go up. There's a bunch of different scenarios, different probabilities, right? But what I'm looking at, for me, if I'm trusting my TA and my standard deviations, this is what I'm looking at for the rest of the week. And then Thursday, right? If we create that high a day Thursday, right? If we, oh, all time highs up here. If we create that high of day Thursday, then we'll have a Thursday reversal, right? Where we'll come in and we'll attack this original accumulation. I know I got off topic, but like you said, right, Trey, if we go back to we'll go to the 30-minute because it maps it out a little bit easier. We have different areas, right, where we can expect our standard deviation to work for us. Injection of liquidity, London kill zone or London by itself, injection of liquidity, and then New York by itself. 4 areas to take trades where you don't really gotta, stare at your screen all day. Yeah. I want that too. Okay. I'll go out there right now. Okay. That's you. Bye. I love you. So when we're looking right at our x-axis, what can we now add to it? We have our Asia, our London, and our New York, right? Our kill zone, and our kill zone. We can now add 4 spots, right? Sorry, that's Asia. We can now add 4 spots. 1, 2, 3, 4, where we want to pay attention to time, and we want to pay attention. Sorry, we have 4 areas where time is important because we want to pay attention to what price does at those times. Any other questions? Was it on here or was it DM? Let me see. I'd have to drop down to 3-minute and look when we're done. But the standard deviation, the cool thing about the standard deviation, right, is if you map it on the 3-minute, the 5-minute, or the 1-minute, right, the projections are slightly different, but it's still going to respect your higher time frame. Yeah, it's going to respect your higher time frame, but it's still going to respect this area here, right? Here's your 0 to your 1 to 5. So this area is still going to get respected. So even though you have your 1-minute, 3-minute, your 1-minute, 5-minute, 3-minute, right, whatever time frame you choose for your standard deviation, there's still a nice little zone that's going to get respected because they all are touching each other. That 0 to the 1. Yeah, if you guys don't have any questions, I'm gonna end the stream.